Asia this morning, opening little change, I would say, perhaps bouncing up and down a few pennies, looking for direction, perhaps. Let's welcome our regular Monday morning commentator, Omar Najia, Global Head of Derivatives at BB Energy. Omar, still a market in search of a direction, despite all of the drama of last week. You know, the core inflation in the US sent equity markets tumbling, the big geopolitical meeting between the big three leaders in Uzbekistan, and some surprising commentary there from the president of India, or China and India, but yet no real impact for the oil markets. Your thoughts this Monday morning?
Yeah, I mean, basically, oil, I think, is, short term, it could really go any way. If it breaks, the WTI is trading about 85, 86. It needs to go like $4 or $5 lower to be, an interesting sale. In other words, if it gets below 81.50, then things change. And if it goes above 90, which is another $5, $4.50, whatever up, then it becomes basically a buy. So I think oil and commodities in general, but oil is, it's diverging. There's no correlation between oil and the equity markets. Equity markets in the US, if the S&P can manage to get over 3912, then it could bounce one last time, try and get over 4,000. But it's going to crater. I think basically the next move of consequence on equity markets. We're talking about all of them in the West, from Nasdaq, S&P, FTSE, CAC, all of them, DAX. They're gonna really fall. And I think there's a lot of complacency, basically. So the big idea is that the West going forwards no longer has access to quote unquote cheap energy. And basically that means that their business model of taking cheap energy and leveraging it up, or basically prospering, not at the expense, it's a market, but at the expense of other countries, I think that's going to rebalance. So it's going to be, I think, by the time you see the snow kind of start to melt after the winter, I think you're going to see a completely different Europe and a completely different US, both economically and politically. And I think that's going to have a big impact for oil. So for oil, just so we understand each other, in the short term, it could go up, it could go down, but longer term, it's going to come off, basically, and off big time.
Let's welcome Ole Hansen, Head of Commodity Strategy, Saxo Bank in Copenhagen. Ole, your thoughts on that correlation piece between the equity markets and oil and the commodities, and particularly in this week as we look ahead to what seems to be most definitely another 75 basis point move by the Fed?
Well, there's no doubt that that correlation is there, because the stock market is trying to price in a further economic deterioration than the one we have seen already, because obviously we're not really seeing any major setbacks yet, but the market is pricing in that to happen. And I think Omar is correct that when we go into the early parts of next year, then we will see the U.S. economy come off the boil. That's also potentially sowing the seeds for the recovery in the stock market, because perversely right now the stock market is reacting negatively to strong data and positively to weaker data because of the impact on the terminal rate, which is currently priced in close to 4.5% in the US by March next year. So we still got another couple percent if we're going to achieve that target. And the question is obviously what kind of economic impact that will have. And but I see the growth slowing going forward. Whether that is going to translate into weaker oil price as well I think this remains to be seen, because the supply side I would say remains equally challenged. I just saw one of the articles you put out this morning that OPEC Plus is trailing their commitments or their target by quite a considerable margin. where will Russian oil go if we do get the embargo kicking in December? So yes, the demand is going to turn weaker, most likely over the coming months. But the supply side, I think, is equally leaving the market guessing in terms of what kind of impact that will have as well. So I'm probably not as bearish on prices going forward on that basis.
Yeah, Omar Al-Ubaidli, Director of Research, Bahrain Center for Strategic International and Energy Studies. It does appear, Omar, that the Saudi oil minister did himself no harm by coming out in recent weeks with that suggestion that OPEC is ready to cut. It sort of kept that don't bring back Iranian barrels thinking you're going to get a softer oil price. Your thoughts on where that balance is? Can geopolitics still trump a declining, a weakening economic outlook and keep oil prices elevated?
Yeah, I think that historically OPEC has not done a particularly good job of managing oil markets, because historically its role has been much more about projecting influence and holding and making OPEC producers feel as though they hold the West, they can hold the West to ransom. But in the last 7-8 years since the crash we had in 2014, I think there's been a significant change in the way OPEC goes about its business, and I think it's now fixated quite in a quite unified way on maintaining oil price stability, because the collapse of oil investments, which as Ola mentioned in the article that he referenced, there's the supply problems are persisting, and supply problems hurt suppliers and the people buying this oil. I think there's a collective awareness that maintaining some degree of oil price stability through good management is everyone's interest, and the Saudi oil minister is showing that trumps any sort of short-term electoral benefits that may accrue to anyone playing around with that price. And I think it's the wise strategy.
Omar, given these uncertainties, where is liquidity at for the market? These are very volatile markets to trade. You have to borrow a huge amount of credit line in order to gamble onto it. Where is it leaving liquidity at the moment and depth in these markets?
Well, depends on futures markets. You don't have to borrow, massively, blah blah blah. On the physical side, yeah. But credit. It's all coming, right? It's surprising. So credit is going to get absolutely squeezed from corporate, bonds, government bonds, corporate bonds. Even the consumer banks. They're not lending, they're going to lend less, they're going to, reduce their balance sheets, all this kind of stuff. So it's all coming. And it's all, I love that piece. I'll mention it again. I mentioned it last week. Credit Suisse said that the Germany on its own leveraged 20 billion with a B US dollars of energy, of Russian gas, into 2 trillion with a T of basically product. That's gone forever. Europe will be, not just, absolutely decimated. And you're starting to see that with the politicians starting to hedge their bet, especially in the opposition in Germany. You're starting to see people go out on the streets, but it's all coming. These Why
would you not have any confidence in the German engineers to be able to create magic Mercedes at a slightly higher energy price?
Man, you have to understand. So people always look very short term, longer term. You've had this thing with the EU where they said, we're going to go green. The answer to everything is basically going to be solar and wind and all this kind of stuff, right? And you got to hug a tree. And if you're really, if you burn fossil fuels, you're evil and naughty and bad. And we're going to transition away and carbon neutral and carbon zero and all this kind of stuff, right? And then what happens? They hit the wall straight on, face plant completely. And what do? We're going to start burning coal. Nuclear is green, and so is natural gas. It's laughable. So this is something that's been thought out and put into action, and they've made massive mistakes. And it's not just this year, and it's not just after the sanctions. That was the mistake upon mistake upon mistake. And like everything in life, the bill's coming due for Europe and the US. It's coming due now, winter after the winter, politically and economically.
Ole, there's clearly we saw last week the ECB move 75 basis points. They appear to be getting, catching up with the US Fed trajectory on a higher for longer, as Mohamed El-Erian would say. And yet oil prices are holding above $90 a barrel. And we still have China yet to come back to the party, in which they could do so in the coming months. We've had announcements overnight that China plan to accelerate projects boosting consumption. Your thoughts of that piece of the pillar in terms of the commodity markets, the oil markets, as an extra leverage of strength and bullishness as we go into clearly a weaker window in Europe, if not America as well?
Well, if the oil market is supposed to be a snapshot of the current supply and demand situation, and we are still holding above 90, then obviously a recovery in demand from China will add some additional input to the upside, or at least adding some support to the price. So I think that is worth keeping in mind. And China obviously will not stay locked down forever. They have an economic growth situation which has deteriorated. They want to get that back on track. And there will be some part of that will be commodity intensive and will require energy. So again, I think that's also still one leg of the equation that could still start to fire and provide some underlying support. And overall, I think the dollar is really key. We've just seen some of the risk on and off in the markets recently has to a certain extent been driven by, or large extent actually been driven by the dollar moves. So if we do start to get a more balanced view on where interest rates are going on around the world, as I would say, especially in Japan, if they finally give up their yield cap, which has been weakening the yen quite significantly in recent months, that could be a trigger for some dollar weakness. So I think the dollar is above everything right now. It still is a key driver for commodities, because it's also there's a stronger the dollar, the more punitively expensive it comes from for everyone to fund their debt and so on. So I see the dollar still remain strong here into winter months, but some weakness would be in our forecast for next year.
A lot of the commentary after last week's U.S. core inflation report was that this was going to be doubly painful for the rest of the world, because what it meant ultimately for the strength of the dollar. Omar, the other, I think, immediate big question coming out of last week into this week, after we heard President Xi and Prime Minister Modi essentially give less room, let's just call it, to Putin in his war in Ukraine. And with the somewhat setback of Putin last week in the terms of the battlefield, ultimately now the question is, where does that go? And then the consequence of that, does Putin double down? Does he back away? Your thoughts on the outcome of that meeting last week, how significant it was, do you think? And what does it tell you about the direction of travel going forward?
Well, first of all, I'd say that I'd be very wary of I'm not a military expert, but I'd be very wary of the battlefield advances made by the Ukrainians as reported by the media, because unfortunately, sort of international Western media has been very keen on presenting as
well. Let's not go too down that rabbit hole, just because I think it's worth noting that on this occasion, the Russian media and the Russian military acknowledged their military losses. So we don't want to go down into a hole in which that wasn't the case, but please proceed.
Well, I'm just saying that I think that the successes are probably, as reported, are probably an exaggeration of.
I think the word I used was setback, but
or the setbacks that Putin's. I think they're not as big as one might imagine, but time will tell. I think that the history of military warfare with the Russians gives a pretty clear indication of which way they're likely to go, and I think it may ultimately be successful. But certainly, in terms of going back to your question regarding oil markets, I think that everybody's really waiting. Go back to what Omar said at the beginning. Everyone's really waiting.
But I was just picking up. Sorry, the other part of my question, which was really the bigger weighting of the question, is what kind of space that Xi and Modi gave to Putin or took away last week from the point of view of where that likely is to play out geopolitically.
So I think, as I say, first of all, I'm sure you saw the pictures of Putin walking hand in hand with Erdogan, and I think that the message I'd be getting, first of all, India and China are quite happy to play fair weather and to back whoever seems to be on the up and up. I wouldn't put too much stock into the signals coming out of that. I would say that the setbacks that Russia has faced and the leeway that he has have not changed anything particularly and what we're waiting for to see something really change in terms of the geostrategic equation is what's going to happen with Europe this winter. Is it going to buckle politically or not, or is it going to be able to withstand the pressure? That's really where all the action is. I think that the statements and the messaging by Xi, by Modi, by Erdogan, and so on and so forth, that's all just posturing, a bit of plus minus there, but we really won't know what's going to happen in terms of major changes until we see, is Europe going to get through the winter or not? And to be honest, I think it's going to be very difficult. We'll see. Maybe Omar has.
Of course, Europe are going to get through the winter. It's not like it's going to disappear. It doesn't fall into the Atlantic Ocean. Are they going to be a little colder? Yeah, they're going to be a little colder.
A little colder. So you have, I think, basically, and I'm sorry to interrupt. I think basically that's the problem is that everybody's sitting and saying it's going to be a little colder. So again,
listen.
You
Get all
energy.
dramatic about it. If Europe has survived 100 years of world wars where the place has been collapsed into rubble and has come back to being globally leading economies. You've got to recognize history to inform your present.
Go ahead. But can I just ask you, our children, if they don't have Wi-Fi, they freak out, right? They absolutely go bananas. There's no Wi-Fi. My God. Well, the people who are older, right? I mean, those who were 75, 80, whatever, they've experienced stuff. These kids, this new snowflake generation is not. What you're talking about now is massive price increases. And what you're talking about now is massive energy increases. So the actual business model of the EU has gone belly up. But not only that, the people, the consumers, the voters are going to see radical changes, not just now, but going forwards in their quote unquote wealth, right? In Canada, I think they lost like $1 trillion of wealth in a month or something. The bottom line is they're going to be cold. They're going to see rampaging inflation, and they're going to be really, really pissed off. And the only thing that Europe is going to be able to tell them is basically whatever it is. I don't know, stand with Ukraine. We've got to commit suicide because, Putin is evil, whatever it is. But look at the stuff that people like van der Leyen is saying. She said, quote unquote, we want to reduce the Russian economy to tatters. We have to punish the Russian people. And this is basically somebody who's not been voted in. This is a bureaucrat, right? So it's a complete and utter disaster. I forecast Olaf Scholz will resign. Liz Truss, I hope that she resigns, but most probably not. But the UK is a disaster. All they do is borrow more and more.
Okay.
Can I
please,
break in
Ole,
now?
As the only person who lives in Europe.
The only person who lives in Europe. Yeah. My chief has just been a tour in Asia for the past 2 weeks, and what he's finding striking is everyone basically predicting the demise of Europe. They're going to be so incredibly wrong. Gas prices are going to be at least half the price within a few months. What we're seeing right now in Europe is, and what I've noticed is that I'm okay. Everyone I know is okay, but everyone is talking about what can they do to bring their electricity down, to bring their gas down. And that is really the talk of every dinner conversation around Europe is how can we contribute. So basically, I predict that the gas demand in Europe will be much less than the reduction we've seen already, which is around 15%. Will be even bigger when we go into winter. People are prepared to put on a jumper. We are spoiled. We are spoiled part of the world, and we are and obviously this is a bit of a wake up call, and people are really prepared to take that hit. So I'm very optimistic for the coming winter, and I'm also optimistic for the future of Europe. Gas that's gone to the gas that Russia not sending right now is a money lost. They can't send it anywhere else. So I think Putin is probably getting close to the end of his tenure. So I think actually, if Omar talked about a collapse in oil or low oil price, I think the biggest risk to oil price is actually Putin disappearing, which I think we cannot rule out, and that would obviously make a huge change across these different markets. But I don't share that view at all. But it's interesting that everyone outside of Europe is basically looking for Europe to be enrolled by the end of next year. It's not going to happen.
Yeah, let's go to the survey question on the which is more looking at the Fed impact. Of course, that's the big story, at least for the markets as such this week. Fed rate hike of 75 basis points will have little impact on oil prices. Agree or disagree? Ultimately, Omar Obeidallah, where does OPEC Plus go now, do you think? As mentioned in one of the articles in the News Digest, the gap between their actual production and their quota is growing all the time. And if Russia was to lose a few barrels over the winter due to sanctions or otherwise, that gap keeps growing. And yet they are in the midst, or at least supposedly going to have a first in-person meeting in December. Where does OPEC Plus go now with their sort of reenacting their agreements to move into 2023 with this gap between production and quota?
Well, first of all, I think they get a gold star in the era of dysfunctional multilateralism. OPEC Plus gets a gold star for keeping countries like Russia, Iran, Saudi Arabia, UAE all on the same page through very difficult times regarding the and to be honest, I thought that the Russian war with Ukraine would be a real test for OPEC Plus, but they seem to have passed with flying colors. I think that it's
not over yet.
It's not over yet, of course. I think the gap you mentioned is primarily driven. It's not anything strategic or political. I just think it's some technical failures that are stopping certain countries from winning their quotas. I think Nigeria.
But if you were to go back to the table to format a new agreement, you'd have to bring those two things together, no?
What do you mean? Sorry, I didn't.
You'd have to bring the reality of production and quota. They'd have
Right,
to close that.
These are transient. I think these are quite transient, and I think that we're still waiting to see what's going to happen with the Iranian nuclear deal. You mentioned that at the beginning on the soft prices, and is it going to happen? And is it going to happen before or after the US elections? Because as soon as that happens, that's going to be a significant injection. So probably, countries like Saudi Arabia could. Some of the producers could pump out a little bit more, but they're just anxious to see what's going to happen. But I don't think these things are affecting oil prices, medium-term oil prices, in any significant way. I think, as Omar mentioned at the beginning, we're thinking whatever OPEC Plus does, as long as they don't do anything particularly aggressive, then it's really about the path of the economy and the supply chain issues from China that's really driving prices in the midterm.
Given, just Omar, to follow up on that, given the scale of Saudi's 2030 vision, now the biggest construction site in the world, I think it has the honor. Dubai used to occasionally have that, but now Saudi Arabia, which of course is much bigger than anything we have here in the UAE, but just on a scale, they have so many projects and so much underway that one would have to put one and one to two there, that they're going to try and defend as high an oil price as possible. Do you think that will be viable for them to do, and they would be willing to, as they did in the 1980s, for example, cut to keep the oil price up?
So remember, they want as high an oil price as possible, but they don't want that if they're the only ones who are going to be cutting. And their ability to convince other producers to cut is not absolute. Or moreover, much of the investments in construction you're talking about is predicated upon Saudi Arabia having good standing internationally. And if it's perceived to be some sort of renegade oil blackmailing country, then that's not going to help it get tourists and maintain the image. So I think that actually Saudi Arabia is not so much about high prices as it is about stable prices. It just wants the investment climate for oil and the supply environment for oil to be something relatively predictable. It can live with $60 oil, it can live with $70 oil, it can live even with $50 oil. What it doesn't want is sharp, up to 113 and down to 20 and then up to 70 and so on and so forth. And I think that it's using its influence to maintain stability rather than to get the price as high as possible, even if that means low revenues for itself.
Omar, you're saying that this market could actually move in either direction. Do you see anything on the horizon in the immediate sense? Do we go through the start of another week in which that direction doesn't come, that breakout, or does it? Do you see that it could emerge?
Yeah. There's no kind of brainless kind of direction, and there's no kind of confidence that it should be higher, it should be lower. But let me also give you like an idea. So basically, people trade cracks, which is the strength of gas oil against crude, right? And usually, distillate cracks are a sign of industrial demand, much more than like consumer heating, this kind of stuff, right? So we were having this argument, I don't know, maybe like 2-3 weeks ago. The cracks were very high, and people were saying, we need to buy them. Winter's coming, and they're going to cut more gas, and Europe will need this, the gas oil and industry. And my reply was, what if there is no industry, right? What if Europe doesn't have any industry left? I mean, they're shutting down all the metal production, all the fertilizer production, all the chemical production, all of that's going, right? So where is this industrial demand going to be? So the oil prices, if you look at them in the long run, they're going to come off. They're going to come off. So if you look,
when you say long run, do you mean
months?
6 to 12 months? Or
no, yeah, months, 6 months, let's say, 4 months, something like that. They're going to come off
through the winter
in the next 4 months, right? Equity markets are going to absolutely dump. And people can do whatever they like. I mean, when you base, everything is to do with energy, right? If you want to produce anything, you need energy. If you want to offer services, you need energy. So it's all good to say, we're gonna cut back. Industry's gonna cut back. We're gonna save, 10 or 15%. That means your economy is gonna shrink, right? There's no kind of magic stuff. But if there was magic stuff, if this green stuff could help, they'd be using it. But they're not. And basically, you also have to understand, gas is not replaceable by coal, right? So think. It's quite interesting.
But it might be replaceable by some of that diesel that you say nobody wants.
No. Because think like, imagine you're cooking, right? On an industrial scale, producing energy, electricity, whatever. When you cook with gas, you turn a little knob, it goes up and down, right? When you cook with coal or diesel, there's no little knob. You vent that, you've got to stop that heating, you've got to vent it somewhere. It's not as controllable. And that's what they need to produce electricity, controllability. That's what they need for metallurgy. All this stuff is going to go. The world has changed, but we just don't want to, we put our head in the ground and we say, no, we'll be okay. It's all coming back and we'll come back stronger than ever. I don't think so.
Ole, let's give you the last word this morning with the survey result. Agree or disagree on the impact of the Fed rate. Generally, the room is saying it'll have no impact on oil prices. Your thoughts looking forward to this week? Would a surprise 25% forecast now seeming 100 basis points could be under consideration, or at least, as they say in the debate, at the table, and so then consequently would be in the press conference and in the notes that come out of the meeting, which in themselves would be significant. Your thoughts on where this week goes vis-a-vis this announcement?
Well, I agree to the no impact, and by saying no pay impact, it's within a few dollars either direction. So
Yeah.
no major impact from 75 basis point. If they do, however, do 100, or they signal that that could be done as well, I think that well, from a growth perspective, that should be negative, but again, it should also be potentially negative for the dollar, and we still have to remind ourselves that a lot of this trading is also related to what's happening on some of the outside markets. So I think the market is the central bank will eventually have to start worry a little bit about the economic growth impact of their actions. So I think they will be cautious, and 75 basis points is probably as much as they're going to give us at this juncture. But I'm still waiting looking mostly for signs of where this terminal rate is going to be, whether it's going to be 4.5, whether it's going to be 5, because that really will determine what the kind of economic impact we'll see next year on housing, on mortgages, and so on.
Did you see anything, Ole, in the CPI result or the inflation report last week that would signal toward, I mean, Mohamed El-Erian and other things saying, well, this is indicating higher for longer. Would you concur with that?
Yeah, the numbers that saw the biggest increases away from food and energy are sticky ones, and those are we're not going to get those to turn lower anytime soon, and that really is that's also the risk in the market, that the market is pricing in inflation to be back below 3% within next year, and then it's going to stay below 3% for in the coming years. I think we're probably going to see a readjustment of those expectations. Whether it's going to have a major impact on oil, it's probably more for investment metals like gold that will have an impact on the positive sense. But generally, these changes will impact the dollar, and I'm looking for that dollar to weaken eventually, and that could also help balance some of these markets.
Interesting. Okay, thank you so much, Omar Obeidallah, as always, Omar Najia, as always, and Ole Hansen. Great insights by everybody. It's certainly another Monday morning where it feels like a week could deliver anything. What it's going to deliver today, for certain, is the burial of Queen Elizabeth II, and so condolences to all the British people that are commemorating that event. For the rest of us, getting back to work.